In today's video, we are going to look at a case study where an individual is funding a policy with a total of $1 million. How he would like to fund the policy is day one, he wants to send half of that $1 million to his policy. So he's starting out with a check for $500,000, a nice lump sum into the policy, he's front loading it. Then what he would like to do after that is fund the policy at $100,000 per year until he hits $1 million. He's 55 years old now. His plan is to fund it for a total of 6 years, $500K in the first year, and then 5 more years of $100K up until the age of 60, and then he's done. He does not want to pay anything after that. If he can, that's great, but he wants to be able to stop altogether then. So this is a great case study because A, the numbers will look good. However, this is also a good case study to examine because when we get requests like this, or if you're working with an agent and you're interested in a design like this, whether it's $500,000 upfront, $50K upfront, whatever your situation calls for, I would look at an alternate strategy here that will produce stronger results, both in the long-term cash value and death benefit, with keeping the exact same product. So if we can improve the overall value of the policy without looking at a different product that might illustrate better results, keep everything the same, if that can be improved, that's important to see, or at least be made aware of, because to you, the policyholder, you're paying the same amount in, we're just looking for a more efficient way to do it. Because if you maximize the value first, what does that do? That gives you more money to work with if you're using it for opportunities or just letting it sit and grow. So the two scenarios we are going to look at are as follows. We've got option A, which is year one, $500,000, and then years 2 through 6, $100,000, that's per year, for a total of $1 million deposited into his policy. Option B will be 4 level payments of $250,000. Again, a total of $1 million. Couple notes here I want to go through. So the product here is a Guardian 10-pay policy. Guardian is one of our major mutual companies. A 10-pay policy, one of their 10-pay products, has a guaranteed rate of 2%, which is the lowest guaranteed rates can be with whole life insurance products. A lot of times you'll see 10-pay policies with different life insurance carriers have a 2% guaranteed rate. And what's important to be aware of here is if you have a 2% guaranteed rate, you will see the lowest starting death benefit. You'll see the lowest guaranteed cash values, but when you look at the non-guaranteed cash values, that will be the highest. So some boxes we'll check as we look at the policy is A, premium flexibility. If he picks either option, does he have to fund that exact amount every single year? Second box, the indexed rider. We are going to look at that as that does give him greater earning potential on the policy. And then 3, 4 to 5% tax-free. What does that mean? We're going to go through exactly what that means, tax-free. We'll look at taxable equivalents. You'll see a lot of value here, especially if you're in a higher tax bracket. So let's begin with the comparison, shall we? So first, what we'll look at is exactly what he wants. He wants a policy where he's starting out with a lump sum of $500,000 and then funding $100K per year thereafter. So as we look at the breakdown of this policy, we're going to look at a simplified breakdown on Excel in a minute, but let's look at the actual illustration first. Net premium. This is showing the total out-of-pocket we're paying each year. $500,000 in the first year, and then $100K per year through age 60, and then nothing thereafter. Here's his total payments over time. He gets a total of $1 million in and pays nothing thereafter. Now, up here is his premium. That's very low relative to the first year payment. So Guardian has a specific rule where they will allow us to illustrate up to 50 times whatever the base premium is in PUAs in the first year alone. Most Guardian products after that, provided we have a 1-year term rider attached, will allow us to illustrate 10x the base premium paid into PUAs annually. The 10-pay product does not offer the same rules. We've got some illustration limitations here. When we have this term rider attached, instead of 10x, we can illustrate an additional 5x the base premium into PUAs. So a 10-pay policy does offer greater non-guaranteed potential. However, the trade-off to some is that I do have a higher premium requirement as the years pass. Because normally, if this was a different product with Guardian, an L95, for example, we would actually set that premium at $10,000 in the first year, where we're still paying $500K and then have the ability to still pay $100K per year. Why it's at $20 is to accommodate this annual funding of $100,000 based on the software limitations. So this is the big lump sum payment up front. Let's look at the level pay now. What do we got here? 4 payments of $250,000. Here's how much you're funding, a total of $1 million. Where's your premium? Higher than the last example. Why is that? Because you're paying in less in the first year, only $250K. Reason why, again, has to do with those limits. So whatever the base premium is, we can illustrate an additional 5x that in PUAs per year. The first year we can go up to 50x, but that's only the first year. So based on the desire to fund 250, we got that premium as low as we can. It's a couple $100 higher. The lowest would be like $41,600 and change. I rounded off. But because we've got 4 level payments here, that premium is a bit higher. But with that said, what's the performance look like? Let's take a look at the comparison, shall we? This will be interesting. So what we have on the left is, again, the option he was interested in. When he comes in, he says, here's what I want to do. I want to start out with $500,000 and then fund $100K per year thereafter. Up until I'm age 60, I will have gotten a total of $1 million in the policy. That should look pretty good, right? The response, yes, it should look pretty good. And it does. However, we can actually improve it a little bit. If you'd like to see an alternate funding strategy, it just has to do with you getting the money in a different fashion. Would you like to see that? Yeah, I'd like to see it. I would like to see it. But before we progress on to that, break-even point in this guy, year 5, this is a strong policy. And if he wants to get the money in faster up front, this can absolutely work. However, when we compare it to the other option we just saw, what do we have? 4 years of $250. After that, nothing. Cash value performance, breaks even year 5. We've actually gotten a total $1 million and faster. If we look at a comparison here, or I should say if we compare the cash value and see which one has more or less, what do we notice? Well, this column, cash value difference, is going to tell you how much more or less you have in cash value with the four-year funding option directly compared to the option on the left. So the first 2 years, you've got less. And the reason why is because you've gotten less money into it. You've gotten a total of $500,000 in by year 2, whereas this example, you've gotten a total of $600,000 into the policy. However, as time passes, what do you notice? We got slightly more, and it just gets stronger and stronger. Same company, same product, different design. Interesting stuff, isn't it? A question comes up here sometimes on this piece. Years 5 through 7, there's still a premium due, and it has to be due, because if it's not, or if we get rid of it, we'll trigger a MEC. The premium has to be there, but he's not paying it in this example. A lot of people will do this. What we do in this particular case, there's 2 things we do. The first is when we are done funding the policy, when year 5 rolls around here, he has the option to continue to add money. But if he says no, like my plan was to get $1 million in, I want to stop here as we originally agreed, what we would exercise, the term is a premium offset. What this does is elect the dividends and interest to cover the base premium and the cost of the term rider, which is doing, then the excess is kicked back into cash value. So we're still performing here. It's going up, which is good. We never want to see that go backwards. So in this example, we've got 3 years where the policy is funding itself. And then what happens in year 8? This is the second step. We illustrate a reduced paid up option. This is optional. Even if we go with this policy and we send this to the insurance company, This will not happen unless we actually make this change in year 8. So we do need to be aware of that as the agent. If you're working with a local agent, you do want to make sure that they're aware of that or help make them aware. This way we can make sure that we optimize the performance after we've funded it. So let's go back to the Excel workbook. There's our comparison. So premium flexibility, that was our next topic, or next point we wanted to hit on. So with premium flexibility, what was the premium on the example where we had $250,000 per year? It was $41,700. We've got $250K per year going into the policy. You have to pay that $250 every year. No, you don't. What he would be committed to in this example is this and this. This is the cost of the term rider. This is the term rider amount. The purpose of the term rider is to add more death benefit to the policy, which will prevent a MEC limit. The term rider is often the cheapest way to raise the death benefit and raise the MEC limit so I can keep my costs low and maximize the cash value. That is the name of the game. But the commitment here, if we just round up, call it 43, if you want a clean number, maybe it's 45K per year. A lot of people like this, where they know they can fund this. This is what their plan is. They might even have the cash on hand, but they say, if I'm just billed for this and I can add the rest at discretion, I'd actually prefer that. This way, if my cash is out in the marketplace, it's at work, it's in my business, I need a couple more months before I want to send it to the policy, I can do that without feeling pressure that I have to fund this full $250,000 amount every year on my anniversary date. So it's nice to be aware of that. You've got a lot of flexibility, particularly with Guardian here, we can just add funds at discretion. And all companies have different rules too. And that's something we talk about quite a bit regarding PUA flexibility. This is specific to this particular illustration in this example. Indexed rider. Let's check this guy out. So what this is, the indexed rider, is a rider that allows us to link our cash value to the S&P 500 index instead of receiving the basic dividend rate from the life insurance company. Now, what we can do is switch back and forth as the years pass. We can even go 50% index, 50% dividend, maybe it's 10% one, 90% the other. We can adjust it every year, which is nice. So it's not as if it's all or nothing. There are some drawbacks to that rider. You will see the company assess a fee. We do have a video, you'll see it up top, that provides information on the indexed rider and how it works. So let's take a look at an illustration here. Here's the 250. This is the dividend illustration, and how you can tell based on this, identical up top, identical the first 3 years. So look at year 3. You know what? Let me go back to the 0% index. Your year 1 cash value, 205. Your year 3, 700, 572. Okay. Indexed rider. Only difference, the indexed feature is at 100%. Year 1, 205. Year 3, 700, 572. No difference there. The first 3 years, even when the indexed rider is elected, we're still receiving the basic dividend. That only happens if we have a 1-year term rider, but that typically makes the most sense if I'm trying to juice the cash value. However, beginning year 4, you'll begin to see the indexed rider look more attractive. See the difference in value? This is the dividend illustration I went back to. Year 10, you're at 1.261. Indexed illustration, you're at 1.319. So we are starting to see that pull ahead. The reason why this illustrates better is it's pulling on the past 20 years of market history. We've got a 10.5% cap here. How I look at it is like this. It's a nice rider to attach to a policy because we do have a little bit more upside on earning potential. However, in my opinion, it should not make or break a decision with me going with one company or the other. If we like Guardian for all of the benefits aside from the indexed rider, then it's a nice added bonus because we can attach it, leave it at 0%, and it never costs a thing. Functions in an identical manner to what it would if we didn't have it in the first place. However, if we do have it attached and decide to use it in some years, and we hit some nice doubles, triples, maybe some home runs, and like, woohoo, we had it. This is looking pretty good. Let's look at a side-by-side, shall we? So what we've got here, to the left, is the dividend illustration. This is the 250 for 4 years, a total of 1 million. Break even year 5. Okay, looks great. Here's the same policy, same product, but with the index rider exercised. You'll notice the first 3 years, there's no difference. Beginning year 4, there is a difference in favor of this guy here. If we look at the year 20 mark, what's the difference in both cash value and death benefit? Is it noticeable? Yes, it is. Quite noticeable. More than 200,000. It's more than $250,000. So you do have the higher upside there. But again, this is all based on the past 20 years of market history. Things can change and will likely change, but it's a nice option. But that is the indexed rider. Let's look at this. So 4 to 5% tax-free. Core benefits to a cash value life insurance policy are what? Safe, liquid, and tax-free. Tax-free provided we don't trigger a MAC or another taxable event. I'm going to talk about a couple things here. We're going to look at the annual growth, which is how much the policy is growing by each year, and then also the average growth. So we'll look at it, the terminology the insurance carrier uses, which is the internal rate of return. All right. First year with a life insurance policy, you have more or less than what you've paid to the policy. Even when the cash value is maxed out, you've got less. The hit's around 10%, sometimes it's a bit more. So we take that hit on our money up front. Therefore, in the first year, I don't care what the dividend is, I've got a negative hit on my money. So my IRR would be negative. The average is going to factor in what the annual return is in all years and give you an average. So let's take a look here. Here we go. So you've got the dividend on the left and the indexed on the right. And what do we notice here? Annual IRR. First year, this is a hit, 17.8%. Why is that? The reason why, because $250 was paid in, he has $205 in cash value. If we associate a percentage with that, that's a loss of 17.8%. This is the number one drawback to whole life insurance when people are focused on the cash value. This is what's always expressed. Year 2, you pay in $250. The end of year 1, you're at $205. If we add $250 to $205, what would you have? $455. What do you have here? $447. That means you got less back than the $250 that was paid in. That's why the annual IRR is negative 1.8. Year 3, $250 is paid. You were at $447. You added $250 to that. You got your $250 back and a little bit more. If you just add $250 to $447, it would be $697, so we're a bit higher. That's why the annual IRR is higher this year. So the annual IRR is isolating what the policy is growing by for that specific year. What did I earn this year? What did I earn last year? That's why I would look at the annual column here. So as time passes, the annual looks attractive. And this is based on the present dividend here. But then here's your average. So this is what sets us far behind the first year. So as you've got these annuals that are higher and higher, or high each year, that's going to pull up the average. But if we look at year 10, you're 2.76. If we look at year 15, you're 3.52. Year 20, you're 3.85. Eventually it hits 4, but this guy's almost 80 years old at that point in time. So it's beneficial to see that. Now, if you look at the indexed illustration, what happens? Well, the numbers look better. If we look at year 10, look at that annual IRR, 5.6. There's your average, 15. You're over 4. Year 20, you're at 4.53. Now, when I'm looking at these, what I always like to keep in mind is that this is a safe area to position money. The liquidity is also there, which is nice if I want to take advantage of the loan feature. But what about the tax benefits? How does that work specifically? Well, if I'm in a high tax bracket and I don't have to pay tax on this cash value, provided I don't, again, trigger a taxable event, I can view this as a tax-free growth rate. How valuable is that if you're in a high tax bracket? It's valuable. let's illustrate. So let's assume someone's in a 30% tax bracket. You know what? We'll do a 30 and a 40. Because a lot of times when we get these questions from people, it's, hey, I'm in the highest tax bracket, or I'm in a 30% tax bracket. What's the benefit here? So we'll look at both. This will be interesting. Let's go tax rate at 30% and then tax rate at 40%. And what this is going to show us is what you would have to earn in a taxable account to net the same tax-free IRR here. Here's the annual. There you go. And we'll put these in purple, just so they pop a little bit more. Put this in light blue, 40%. So again, what this is showing here is what I would have to earn. If I'm in a 40% tax bracket, I would need to earn 9.35%. This is in year 8 before tax. And then after taxes are accounted for, I would be left over with a net of 5.61%. So that's how those equivalents work there. Let's do the same thing with the average IRR. There you go. Interesting stuff, isn't it? Do the same thing with the basic dividend. We like to look at things more conservative, which I do. Here we go. Look at this. It all fits. So the tax bracket will make a difference, right? When we look at the actual growth rate of a policy. So if I've got a 4% tax-free IRR, that does give me more buying power, if I'd like to call it that. With all of that said, none of this is tax advice, as I am not a CPA or tax attorney. But I do like going through this because it's a question that has always come up with life insurance because of the tax benefits that surround the cash value. People are interested in this. So I hope that you enjoyed this video. It's about front-loading a policy, but we looked at a lot more there. If you have any questions, please let us know. Please leave any comments below. You can always reach out to our office direct. If you have questions, feel free to email us at info@ibcglobalinc.com. And as always, I hope this helps. Thanks so much for watching all the way through. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.